All right, we don't want to get ahead of ourselves, but mortgage rates are beginning to fall right now. A 30-year fix now at 5.30%, I should say. Last week it was around 5.70%. It was touching for a while as much as 6%. So it's down now. Now, we're not going to go nuts on this. Keep in mind, at the beginning of the year, we were at around 3.22%. So kind of pick or compare your mortgage poison here. Douglas Holtz-Eakin joins us right now, the former director of the CBO, the Congressional Budget Office. What do you make of this? It could be in response pretty much to the feared slowdown that will come with all of these rate hikes, but it's certainly driving down mortgage rates. What do you think?
Well, I think the backdrop here is that the Federal Reserve almost certainly has to really lean on the housing market. Because it's a big part of the inflation problem. It's 5.7% in shelter, and that's a third of the consumer price index. And B, because the tools they have are going to hit houses. I mean, rate increases lead to mortgage interest rate increases. And they're also switching from buying about $30 billion a month of mortgage-backed securities to selling off $35 billion. So that's a big swing in the amount of government capital that's getting injected into this market. So having done that, rates jumped up, as you said, and they essentially shut down the refinance market. It's gone. And the purchase market's down about 15%. And we've seen the mortgage interest rates come off a little bit. But the reality is they will continue to raise rates until they slow down the rate of inflation in housing and they slow down the building of housing and slow down the economy as a whole. And so this little respite probably doesn't mean a big change in the big picture.
You know, it's interesting, though. The Federal Reserve doesn't, control all rates. I mean, obviously, short-term rates that they adjust and have been ratcheting up. I guess expectations are in a couple of weeks they're going to ratchet them up another 0.75 of a point. Maybe the same in September. But maybe the bond market is saying, I know I'm sounding wonky here, we think this will slow things down. And things will just slow down to the point that either if you're looking for a house or refinance when you're already in, you take a chance to leap at that or you don't. Something tells me, even though these look more tantalizing than they once did, people aren't going to leap at them.
I suspect you're right. And the one thing I'm sure of is it will slow down. I mean, that is the game plan. And if it didn't slow down, the Fed would simply lean harder. It doesn't have great ways to fine-tune the economy. All it can do is raise short rates, as you said, and those higher short rates get built into every other interest rate in the economy. So they can't really single out car loans or single out mortgage interest or single out any particular kind of credit.
But
they're going to make it all more
Doug,
expensive and see where it lands.
I'm sorry. Do you look for a housing crash? I don't see the same bubble we had, let's say, over a decade ago, the meltdown. I don't see that, or just a slowing.
I don't think you see the big house price crash that we saw a decade ago. There's no evidence of the sort of bad underwriting, the poor mortgages. There's no evidence of widespread flipping of houses, all the phenomena that really fed that housing bubble. There's a real hot housing market with a lot of people chasing a relatively small supply, and the Fed's going to slow down the number of people chasing that supply. That's their goal.
Doug, always good seeing you again. Thank you, my friend.